Hello, and welcome to our third quarter strategy review. The summer quarter, typically the quiet quarter and the relaxed quarter, but we met on Friday in this room to discuss strategy, and as we talked about it, we're glad we didn't meet on Thursday, because Thursday was the vote on what I'm sure all of you are now familiar with, Brexit. Nobody was familiar with it probably, although we were prior to that time. When the vote went the opposite way as than expected, we had to obviously deal with what does that mean. And of course, everybody's still dealing with that question at this point. But putting it in perspective, on Thursday, markets were up. And as a matter of fact, Art Cashin, a CNBC commentator, said obviously someone knows something, and he was referring to Brexit, referring to the fact that the vote was going to go for them to stay in. But it went the other way. And of course, markets always don't like indecision, and they don't like surprises. So we had both of them, and we had to deal with them on Friday as everybody else is dealing with them, including today on Monday. As we go through our review, we're going to try to emphasize what Brexit meant, what Brexit means, and the strategies and the changes that we've used to implement a strategy to best take advantage and deal with the indecision that's out there. So first of all, I'd like to deal with where that indecision is the greatest, which is international. So Len, international is your area.
Thank you, Stan. Well, as Stan pointed out, with the Brexit, it just got interesting. Britain decided to leave the EU, and what that actually means is a little uncertain, and markets don't like uncertainty, so they've been reacting negatively for the last couple of days. But once this all kind of settles down a little bit and we get a better sense of what's happening here, we kind of see that it will probably in the end be maybe even a positive for the United States with a stronger dollar and with lower interest rates for a little while. In terms of the impact internationally, however, Britain is probably going to end up having a pretty severe response here. And with Europe, it's probably going to impact them negatively as well, to a lesser extent. We'll have to see whether other countries decide to follow suit. The EU has always been kind of a situation which was probably not long-term sustainable anyway. And we'll have to see how this ends up impacting a lot of the other countries that are in there and what they decide to do. With respect to more immediate financial issues related to it, we do see this probably prolonging the European recession, or at least delaying the recovery. They were in the beginning stages of a recovery. They've been struggling to try to get things going, and we don't see this being a positive in that regard, so it will probably continue to keep things slow there in Europe for a little while. There aren't a lot of areas of the world that we see as positive areas to invest in right now. We do not particularly favor the European areas. We do not particularly favor a lot of the Asian areas. We have a lot of issues with some of the things that are going on in China, and so particularly with a potential banking crisis there, we really do not see a lot of areas that we feel merit our attention in terms of wanting to put a lot of additional investment there. So what we have done is, as we have for most of this year, gone to the minimal allocation that our model allows. And we continue to maintain that minimal allocation in international for the coming quarter. And we continue to invest only in developed countries, the larger, more solid economies, and not playing around with some of the smaller ones during this period of uncertainty. With that, I'd like to turn it over to Bob for some comments on the U.S. economy.
Thanks, Len. So yes, as Stan and Len have both discussed, we had a major economic event last week with the Brexit vote going in a manner that was unexpected. So when Len commented a little bit on how this might impact the U.S. markets or the U.S. economy. Let me first talk about that. We believe it will have some modest impact on the U.S. economy, but not a major impact. We have been thinking about economic growth in the U.S. economy of around 2.5%. This could potentially shave a few tenths of a percentage point off that growth rate as the Western economies grapple with how this is all going to play out. And I really want to emphasize that, none of us really know. I think everybody on Wall Street is essentially just making educated guesses on how this is all going to play out. We really don't know yet. But there probably most likely will be some dislocation in the European economy. How much, we don't know. That will have some spillover effect on the U.S. economy. Again, at this point, we think it will be modest. We look at inflation and interest rates. Inflation continues to remain low. The PCE deflator, which is the main inflation indicator that the Fed looks at, has been running about 1.6%, and our economic sources continue to forecast PCE deflator remaining under 2%, which again is a trigger point for the Federal Reserve. In terms of the Brexit impact on the economy, as I mentioned, global ramifications, we see some modest impact on the U.S., potentially some modest reduction in U.S. GDP growth. But I do want to talk about corporate profits for a second. Corporate profits are one of the primary drivers of stock prices. And we had seen a recovery in the second half of this year in corporate profits and moving into 2017. I don't think that view has changed, although I do believe that there could be some modest downward revision in corporate profit growth looking into the third and fourth quarters and into 2017. Again, it is, I think, still very preliminary and still very difficult to I think, forecast with exactitude how this is all going to play out. So we're going to be watching it closely. I think it's safe to say there will be some modest downward pressure on corporate profits. But as Len mentioned, I think the U.S. will continue to be viewed as a safe haven. We think that in an environment of uncertainty, global money flows will continue to flow into the United States stock and bond markets, and that should really support our markets. And I think that all of you as our clients should take some comfort in that the U.S. really still remains the strongest and most stable economy in the world, and that is very positive for our markets and for the investments that we have your portfolios invested in. In terms of Fed policy, of course, as you know, that's been always a huge factor in the markets. We think Fed policy is essentially put on hold for now. There had been some talk of a potential rate increase in July or September. We think those are definitely off the table right now. And in fact, we are seeing more and more forecasters out there talking about the next Fed rate increase could be well into next year. So at any rate, that is the quick U.S. overview. I'm going to turn it back to Len to talk a little bit about fixed income.
Thank you, Bob. As Bob was saying, Fed policy is probably going to be impacted by what's going on with the Brexit. And one of the most significant impacts here in the United States is likely that the Fed, who was on track and probably wanting to raise interest rates in the next month or so, will most likely not do it. In fact, we don't see any way that's going to happen right now. And for the foreseeable future, it seems like we're going to continue to have very, very low interest rates. Most of the rest of the world has negative interest rates, or at least a lot of the rest of the world does at this point, and a growing amount of the rest of the world does. So our low interest rates are still higher than what's going on elsewhere, and continues to make the U.S. a relatively attractive place from a fixed income perspective relative to everyone else. We are continuing to allocate ourselves pretty much evenly across the board now. We're at a normal distribution for both our short, intermediate, and long-term bond allocation. And we have tried to add some additional income into the portfolio through some dividend-paying stocks in some areas, including in utilities, which we have added to our small cap area and which will be discussed elsewhere. But in terms of just relative interest rate policy, the other thing we should probably discuss is the fact that we did put a trigger in this particular meeting. We put triggers in a lot of our meetings to allow ourselves to respond to situations that we consider unlikely but possible in the coming quarter. And in this particular meeting, the trigger that we put in place was to get extremely conservative should something happen whereby the 10-year rate on U.S. Treasury goes below 1%. Now, to put that in perspective, here's a chart on the 10-year rate. You can see that historically it's been going down for over 30 years. And it is at or near its lows right now, but it is still a reasonable way away from 1%. Should it drop all the way to 1%, we would consider that to be a reasonable signal that something was significantly wrong in the U.S. economy and that something needed to be addressed and that we could be in for a significant problem. We're not anticipating that it will do that. We just are planning for the possibility that should it occur, we will be in a position to respond. But for now, we're going to continue to go along with the idea that it's just a low-rate environment and that things are fine. With that, I'd like to turn it over to Stan to talk about some changes to our natural resources area.
Thanks, Len. Natural resources are certainly a part of our model, have always been a part of our model. They've primarily been there for protection against inflation. And during this period of time, inflation is very, very, very low, and the current situation doesn't speak towards inflation going up. However, we have in the past used gold in our natural resources, somewhat because of its inflation sensitivity, but also because it is a point where people go to when they're uncertain, and it's a point that they go to when they're frankly somewhat concerned about the economic situation. And certainly this Brexit situation has caused that kind of activity. As a matter of fact, you'd have to look long and hard to find things that were up on Friday, but gold was one of those things that was up. Now, we have, again, owned gold before, and we are now going to be owning gold again. And again, that's why. Number one, because it is a place where people go to when there's uncertainty. It does represent a hedge, basically, against all kinds of negative financial situations. One other thing that Len mentioned is negative interest rates. I know whenever I mention that to anyone, they say, well, why would anybody put their money away and actually have to pay somebody to do it? And there's a lot of ins and outs that go into that, and maybe nobody really does wind up paying it. Maybe it's the cost of the banks. But interestingly, one of the negatives to owning gold is cost of carry. You have to actually pay to hold it, you have to pay to store it, etc. But with negative interest rates now spreading, and we've talked about it at previous meetings, it becomes cheaper to own gold rather than get negative interest rates, because even that cost is offset. So again, one of the changes that we made, probably one of the major changes that we made, is recognition of the uncertainty and protecting some of your money with the ultimate protection, some gold, instead of other natural resources. And with that, I'm going to turn it over to Bob to pretty much talk about the other changes that we've made at the meeting Friday.
Thanks, Dan. A great discussion on gold and the importance of why we decided to add some gold to your portfolios this quarter. As a result of that, we did eliminate all of our other positions in natural resources. We eliminated energy, forest products, and basic materials because we felt it important enough to have all of our natural resource allocation in gold. I'd say in terms of the other holdings in the portfolio, the theme has really been stabilization. And I mean that stabilization during a period of volatility. We do expect looking forward that the markets will continue to be volatile as they sort through this situation with Brexit and how that will unfold. So as a result of that, within our large cap stock area, we added a holding in consumer staples. It's the XLP. It's made up of a very high quality consumer staples companies like Procter & Gamble, McDonald's, Johnson & Johnson, even some of the tobacco companies, companies like that have very stable earnings and very stable and rising dividends. It's actually shown a very solid risk-adjusted return over the past several years, and we think XLP will add an element of stability within the large cap area. As Len mentioned, we also added a position in utilities, in developing equity. The reason we did that is because utilities also tend to be more stable in a period of market volatility, and they also deliver rising, steadily rising dividends. And we think, again, that will add an element of stability in a period of what might be continuing volatility in the financial markets. We maintained our position in XLB, which is the home builders exchange traded fund. We continue to like that sector. We think it's one of the fastest growing sectors in the U.S. economy, and we think it still offers good value. And we also continue to overweight real estate through the VNQ, which is the real estate exchange traded fund. That has been a stalwart performer for a long time, showing excellent total return in both capital growth as well as strong and rising dividends. And we think real estate, again, adds another element of stability in what, again, we think might be a continued volatile environment going forward. As Len mentioned, we made very minor changes in the bond portfolio, but we're essentially neutral across all maturities at this point. I will end my comments there and turn it back over to Stan for closing comments.
Thanks, Bob. And I'd also like to thank all of you for tuning in to this video, which is longer than usual, but we were fortunate that we were able to deal at our meeting with the unexpected view of Brexit, and we were able to share that with you on this video. As you can see, we still feel that the overall view of the markets is not that bad, although certainly we're not ignoring it. But we think staying the course and continuing to have a highly diversified portfolio, as you all have with us, and that's what we practice in our model, will bring us through to the level where Brexit will be like other items and it will become something that we look at in the past. With that, I'd like to thank you all for tuning in again, and we'll look forward to seeing you next quarter.